In this lecture, we will discuss the steps in calculation of value of a firm using DCF method or DCF approach. There are two versions of DCF approach, two-stage growth model and three-stage growth model. What is two-stage growth model? The two-stage growth model allows for the two stages of growth. An initial period of higher growth period followed by a stable or lower growth period. Now let's move on to the steps in calculating the value of the firm. The first step is analyzing the historical performance. The second step, forecasting performance. The third step, estimating the cost of capital. The fourth step, computation of present value of free cash flows or forecasted cash flows during the higher growth period, or in other words, we call it as explicit period. The fifth step also involves computation of present value of free cash flows for the continuing value or terminal period. The last step, that is the sixth step, is calculating the firm value and interpreting the results. Now let's get in detail to the steps. Step 1, analyzing the historical performance of a company. The first step in valuing a firm is analyzing the historical performance. Analyzing historical performance helps the valuer in understanding how the company has performed in the past. Historical performance is analyzed to get an handover of economic performance. The financial statements shows the financial performance, but to value the firm, we require economic performance in terms of NOPAT, that is net operating profit after tax, changes in working capital, capital expenditure minus depreciation in order to calculate the cash flows, forecasting cash flows or free cash flows. Step 2 involves forecasting the performance. This step involves projection of cash flows for higher growth period as well as for the continuing period or stable growth period. As mentioned in the meaning of two-stage growth model, this two-stage growth model allows for two stages of growth. An initial period of higher growth period, which is followed by a stable or a lower growth period. For these both periods, cash flows have to be projected, wherein FCF is equal to NOPAT minus capital expenditure minus depreciation minus changes in working capital, wherein NOPAT is called as net operating profit after adjustment of taxes. Capital expenditure is the amount invested in the operating profits. And as we know that depreciation is the charge on such capital expenditure. And your changes in working capital is the difference in working capital across the years. Coming to the third step, this involves estimating cost of capital. This involves calculation of overall cost of capital, in other words, weighted average cost of capital. The formula to calculate the weighted average cost of capital is KO is equal to WD into KD after tax plus WE into KE, wherein KO is equal to overall cost of capital, WD is equal to proportion of debt, KD is equal to cost of debt after tax, and WE is the proportion of equity, KE is equal to cost of equity. The overall cost of capital is to be calculated for both higher growth period as well as stable growth period. While solving a problem, in the problem, there will not be a mention of cost of equity. The problem will have information pertaining to proportion of debt and equity as well as cost of debt. Hence, cost of equity has to be calculated for both higher growth period and the stable growth period. The formula to calculate cost of equity under CPM method is KE equal to risk-free rate plus equity market risk rate into equity beta premium, wherein KE is equal to cost of equity. So once the cost of equity and WACC is calculated for both higher growth period and stable growth period, we move on to the next step, computation of present value during the higher growth period or explicit period. So in this step, we calculate the present value of forecasted cash flows for the explicit period. It means the higher growth period. So the future cash flows have to be discounted using the weighted average cost of capital of higher growth period, which we have calculated in the previous step. It is calculated by multiplying the PV factor into the free cash flows for the explicit period. The next step is computation of or calculation of present value for continuing value. So in the previous step, we calculated the free cash flows for present value of free cash flows using the higher growth weighted average cost of capital. So we discounted the future cash flows or forecasted cash flows using the weighted average cost of capital of higher growth period. Now we need to discount or we need to find the present value of future cash flows of the terminal period or the continuing period. It is calculated by using the formula free cash flow of terminal period or continuing period divided by weighted average cost of capital minus growth rate for the stable growth period. Okay, and this is discounted at the higher growth period. Coming to the last step, calculation of value of the firm, we need to sum up the answer of step 4 and step 5. So the value of the firm is equal to present value of free cash flow of explicit period, that is the higher growth period, plus the present value of continuing value. So with this, we come to the discussion of steps in calculating the value of a firm using DCF approach. Thank you.